You've spent the last 40 years saving for retirement, and now you're finally ready. But now what? For most of you during your working years, you had a paycheck coming in every couple of weeks that would go directly into your bank account. But when you retire, it's on you to start paying yourself. So how do we actually do that? In this video, I want to go through the process of how to actually start drawing your savings. I'm not talking about tax planning strategies here, but the basic process of making sure the money you work so hard to save actually ends up in your bank account so you can spend it and enjoy it. If you're not already subscribed to the channel, please hit the subscribe button, join the community. We release 2 brand new videos every single week around tax, retirement, and estate planning. So I had someone reach out the other week and ask this question, like, I have an RRSP, I'm retiring, what do I actually do with it? And that's what we want to go through in this video. So let's quickly start with an RRSP. Most Canadians will have an RRSP, a Registered Retirement Savings Plan. This is an account that you've saved into over your working life. You've got the tax deduction, putting money in, and in retirement, when you pull it out, you will pay tax. It's a taxable income. But how do you get it from an RRSP to a RRIF, a retirement income fund, meaning that it's now a fund that you're going to start drawing income from? You have to convert your RRIF by the age of 71. You don't have to start taking money out by age 72. So the year you turn 72 is the first year you have to take money out, but you have to convert it by 71. Again, typically in planning, unless you're working until much later in life, it typically makes sense to convert as soon as you retire and need an income source off of that. And it's quite simple, but for a lot of you haven't done the research, so I want to give you that detail here today. Now, the easiest place to start with any of this is to contact the financial institution that you work with. They will have resources either online or someone over the phone or online chat that can walk you through this process, because the paperwork's going to differ from company to company, but the general scope of it will all stay the same. So when you retire, or at any point really, but when you hit retirement and you want to convert your RRSP to a RRIF, there's a bit of paperwork to do. The first thing you need to do is set up the RRIF account, the Retirement Income Fund account. When you set up your RRIF account, there's going to be a few things that you need to know going into it. One of it is your beneficiary. Now, if you're married or common law, you probably want to list them as your beneficiary on the account. So your RRIF account, you need to have a beneficiary, meaning that when you pass away, who do you want that account to go to? If you don't have a beneficiary, you can leave your estate. Won't cover all that in this video today, but you do need to know that you have to list a beneficiary. The second part of it is, if you're married to common law, you can base the minimum withdrawal amount on your age, or if you have a younger spouse, on their age. Now, I typically just put it on the client's age, but you do have that option to put it on the lower spouse's age. This would only really take effect or be beneficial for you is if you were 71 and being forced to convert it, but you were still working and you didn't want to draw money out of there. You could base the minimum amount on the younger person. So if you had a spouse that was, say, 60, 10 years younger than you, you could base the minimum on their age. Thus, the year you're 72, the following year after you convert it, there's a smaller amount. The minimum amount that you have to take out of a RRIF is based on age. The younger the age, the less you have to take out. So again, this doesn't apply to 99% of you. You can base it off of your age. Again, the whole concept of like the RRSP meltdown, if that's a good strategy for you, and just drawing out, you typically want to take at least the minimum anyways. But again, there are those few exceptions where you might want to base it on your spouse's age. Again, do that by default. There's no harm in doing that. If you base it off your younger spouse's age, and you want to take more out, you can always take more out of the RRIF. There's no maximum, there's that minimum amount. Again, if you're single, you have to base it off of your age. The next thing they're going to ask you on the application is, how do you want to take your money out and when do you want to start it? Now, hopefully this lines up with a financial plan that you've done with your financial planner, so you know when it needs to start, how much, and how often. If you don't have those answers, you may want to sit down with your financial planner to get those answers first, because those are important answers for this question. I don't know how you actually put how much you need and when you need it if you don't have a proper plan. So start with the plan first, but once you have that plan, then you can put those answers into the application. So it might be, starting next year, I need $25,000 and I'll take it on a monthly basis, and they'll split that up over the 12 months. So that's step one. You've now set up your RRIF. You've gone online, you've done the application, you filled out the beneficiary, what the minimum payment's based off, and what the payments are and when they should be coming in. But the RRIF account is now sitting there and there's no money in it. So we need to get the RRSP over to a RRIF. Now there's a couple ways to do that. Sometimes it's on the RRIF application itself. It'll say, how are you funding this account, and you can put in the RRIF. A company like Wealthsimple, for instance, everything's done online, and as you go through the application, you fill out the RRIF, you can just say, where's the money coming from? And it'll link your RRSP, and it'll transfer the money from your RRSP over to a RRIF. If you're dealing with a broker or an investment person, again, they can walk you through this process. If you are doing DIY and you're kind of lost in all this, again, Wealthsimple, Questrade, these online platforms are pretty intuitive. And again, most of it's done online. And it'll say, look, if you're setting up a RRIF, we know you need to fund it from an RRSP. So which RRSP do you want to fund it from? If you have multiple RRSPs, this is time you could consolidate it. So again, once you've set up the RRIF, you can do a transfer from an RRSP, it might be an old work plan RRSP, into that RRIF account. Again, think of it as a nucleus, and all your RRSPs can come into that RRIF account. Very flexible that way. So when it's all said and done, your RRSP has been moved over to a RRIF, and I'm going to talk about the investment solutions within that here in a second, but your RRSP is no longer funded. All that money has moved into the RRIF account, and you set up who the beneficiary is, what the payments are based off of, and how often and how much you'll start receiving those payments. Now, the question I get a lot of time is, okay, but Adam, I have all these investments in my RRSP. I don't want to sell them and move to a RRIF, so I'm just going to stay in an RRSP. Well, the reality is that we're just changing the name of the umbrella above the account. Think of it that way. All the investments in your RRSP move over just as they are under the RRIF. It's just a different name for the umbrella over your investments. So if you have some great investments in your RRSP that you're not really wanting to do much with, don't worry. When you move to a RRIF, you're not selling or changing those investments in any way. We're just changing the name of the account that those investments are held in. So a lot of you are concerned about that. You don't want to sell those investments or do any changes and all the logistics behind it. It's very simple. You will log in one day, you'll see the exact same investments. It'll just say RRIF account versus RRSP. If you want to read more into this after you've watched this video, we'll link a few resources before, but companies like Wealthsimple have great resources online. Many companies do that talk about and walk you through the process of how to set up a RRIF, how to get your RRSP to a RRIF, how to start drawing income, just what we're talking about today. So if you need to actually see it written down on paper, which I know everyone learns a little bit differently, we'll link that below. I want you to educate yourself around this so that when you hit retirement, you have a clear understanding on what to do with all these accounts that you've worked hard to build up. A few other types of accounts that you're going to run into, as well as government pensions, I want to cover off here as well. First, I want to talk about a LIRA. A lot of people have a defined contribution plan or built up a LIRA locked-in registered account. Typically, it's from a previous employer or your current employer when you retire. And a LIRA is structured a little bit different than an RRSP. So a LIRA, locked-in registered account, RRSP, registered savings plan. Both of them will have a minimum amount. Once you hit retirement and convert them to income accounts, there's a minimum that you need to take out every year. The difference is your RRSP or your RRIF account now, there's no maximum. Whereas your LIRA converts to a LIF, a life income fund, and has a maximum amount. So same minimum, maximum on the LIRA, no maximum on the RRSP. So they're a bit different when it comes to drawing down the accounts and the flexibility behind them. So when it comes to your LIRA and retirement, what you need to do is set up a LIF, an LIF. A life income fund is very much like a RRIF, except again, it comes from a LIRA. Now, if you have a LIRA, I've done a full video on LIRA. I'll link that here above. And we'll also put our link, parallelwealth.com/LIRA. You can learn that, can you unlock your LIRA? When you retire, you're able to unlock potentially some or all of your LIRA, depending on the legislation behind it. So let's say your LIRA is Ontario legislated. That means that you can actually unlock 50% of your LIRA to an RRSP, or a RRIF in this case. So let's go through this process. You retire and you have $100,000 in your LIRA account that's legislated in Ontario. Because it's from Ontario, that means when you convert it to a LIF, you can actually unlock or move 50% into a RRIF. So your $100,000 in the LIRA, $50,000 will move into a LIF, and $50,000 will be unlocked to a RRIF. Now, how do you do the unlocking? This is all done on the conversion and setup of your LIF account, a life income fund. So when we do this for clients, we set up the LIF, we say, where's the money coming from and is there any unlocking? You click yes, and then you put in what account you want that to go to. Now, when you unlock your LIRA, and say unlock 50% in this case to an RRSP, you can either move it directly to an RRSP or to a RRIF. Either or, it doesn't matter. If you're entering retirement looking to set up those income accounts, you typically will convert 50% to the LIF, the life income fund, and 50% to the RRIF, the retirement income fund. So now you have $50,000 on a LIF, $50,000 in a RRIF. The benefit of unlocking this, and again, we'll talk about that in that other video, so check that out, but it really is around flexibility. You can draw more out of a RRIF, there's no maximum, versus the LIF has that maximum. So it's a bit more constrained on how you're able to draw your income out in retirement. So let's just quickly summarize, because the accounts I've talked about are the majority of your retirement accounts, and that's RRSP goes to a RRIF, your LIRA goes to a LIF. Again, depending on the legislation, you may be able to unlock 50 to 100% of it to a RRIF account. So always look into that. Again, parallelwealth.com/LIRA. You can learn more about if you're able to unlock it. A few more accounts you may have in your stable would be a TFSA account, a tax-free savings account. A tax-free savings account has been a great tool since 2009 here in Canada. It's money that you can put in, grow tax-free, and in retirement, you can pull out tax-free. And I've talked about that as a lever account. If you need a bit more money, it's a great place to pull from. And if you don't need all the money you're drawing out, great place to invest into. But if you have a TFSA account when you hit retirement, there's nothing to do. Nothing changes. There's no income account that it needs to move to. It stays as a TFSA for the remainder of its lifetime. Again, you still get that contribution room. You can still keep adding to it through retirement. So it's a very flexible account that you want to make sure you utilize. The fourth type of account you may have is a non-registered account. Again, a non-registered account is just like an open investment account where any investment in there, you're paying tax on any gains every single year. So it's more of a taxable account. Again, there's nothing you need to do with that account when you hit retirement. One caveat I'll say here is we run into this a lot where people with larger non-registered accounts is typically that account that's clawing back your old age security. So make sure you have a really good plan in place to figure out, like, do I actually need all this non-registered money? Is it gonna just be passed on to kids or charity or something down the road anyway? And should I maybe start doing that now to relieve the tax burden from myself, give the benefit to someone else, and start collecting my old age security? Again, for a different video, a different time, but this is something that we look at with our clients as we do planning. So again, your TFSA account and your non-registered or open investment account, you don't need to do anything with when you hit retirement, but they could be a very good source and part of your overall tax planning and cash flow planning through retirement. The next type of account you may have is a defined benefit pension plan. And typically you're a government worker, work for a big organization to have something like this, but this is a pension plan that will pay you an ongoing monthly amount for the rest of your life. It may be indexed to inflation, it may not. There's a lot of factors that play into it, but at the end of the day, a defined benefit plan means it's a defined benefit. Your benefit is defined based on a number of parameters. So when you hit retirement, you're going to get a statement of options. The statement of options could have anywhere between 3 and I've seen up to 28 different options. And this is when you retire, what option you want to take, what income, guaranteed for 5 years, 10 years, 15 if you're married. It could be joint, single life. There's annuities now attached to some. There's a lot of options. And so make sure you talk to your financial planner to figure out what's the best option for you, integrating it in with all the other income and assets that you have going on. Remember, this is not a silo. It needs to work with everything else. And too often people take their pension decision based on that one pension, and they don't look at CPP and old age security and the other accounts that they have set up. So again, make sure you do your due diligence with your planner to make sure that you're taking the best pension option for you. There's going to be a lot of options. It can be very confusing. Make sure you look at that. If you have a defined benefit pension and you're retiring earlier, typically before age 55, you may also be able to take your cumulative value, meaning that instead of an ongoing monthly pension, I'm going to take a lump sum. Some of it you can take as cash. Some of it has to go into a LIRA, again, which will convert to a LIF down the road when you retire. Again, talk to your financial planner, have an apples to apples comparison. Typically when interest rates are a bit higher like they are today when we record this, taking the cumulative value makes a little bit less sense. When interest rates were rock bottom, it made a lot of sense at times. So again, every pension is a little bit different. Talk to your pension provider, your HR department to get more information on that. But this is another account that you need to make a decision about. Again, that statement of options will outline everything you need to do and choose on. And then from there, talk to your financial planner, figure out the right solution, and let your pension department know on which decision you want to go forward with. Now, there could be a few other random types of accounts, an LRSP, a locked-in RRSP. There's some other things that we've seen. You might have some US pension or overseas pensions or retirement funds. I'm not going to cover that in this video. There's other videos out there for that. I want to talk about the main Canadian retirement income sources. The last two I want to cover, of course, are CPP, the Canadian Pension Plan, and OAS, Old Age Security. Now, Canadian Pension Plan, you can take anywhere between age 60 and 70. Your Old Age Security, you can take anywhere between 65 and 70. We've done a plethora of videos on all of these accounts, and we'll link a couple of those above. But educate yourself around CPP, how it works, when it might be best for you to take. And again, sit down with your financial planner, figure out what's best for you. Everyone's situation is different. You need to figure out what the best option is for you. But when you're ready to take your CPP, let's dive into that one first. You can apply either online or through paper. The paper application is done through Service Canada and it takes months to process. You're much better off applying online. Make sure you set yourself up with a My Service Canada website. We'll link that below. Get set up. They'll mail you a code. You fill in the code, you have full access online. And again, that's where you get your CPP numbers, your Old Age Security, a bunch of information is on there. So you want to get that set up typically a few years before retirement if you don't already have that set up. That's where you apply though. You go online and you apply through Service Canada. That's where you're going to apply for both your CPP and your Old Age Security. Your CPP, your Canadian Pension Plan, will not start at a certain age. It's based on you applying for it. So make sure you build a plan, figure out what the best date is, and then apply for it. At 65, in fact, at 64, they'll send you a letter, but at 65, you can apply and say, look, I don't want it now, but I want to start it at age 68. And so you can actually send it in miles ahead of time, and you'll actually see online that it has it triggered for age 68. So you can plan ahead a bit once you hit age 65. For Old Age Security, it's a little bit different. So Old Age Security, OAS, will typically automatically start at age 65 unless you tell them otherwise. Now, I want to say this with confidence, but I've heard a lot of stories where Old Age Security just hasn't started. And so a few red flags I want to be aware of here. First off, don't expect Old Age Security to start automatically at 65. If you want it to start, make sure, again, you let Service Canada know there's an application, you can complete that. Secondly, if you don't want Old Age Security to start at age 65, you need to let them know. Because what happens, and we've seen this a few times, is clients don't let them know. It starts at 65, but they don't receive any payments because they're in a high income tax bracket, meaning that it's fully clawed back. So they don't actually realize they're collecting Old Age Security until the end of the year. They get a T4 OAS statement saying, hey, your Old Age Security, you made $8,000 last year. We clawed it all back, but it's still income for you. Well, guess what? It would have been way better for the client to defer it. They wouldn't receive it anyway. You might as well defer it and get an added bonus down the road. But they didn't even know they started it. So be proactive. My tip to you both on CPP and especially Old Age Security, be proactive in taking charge of it. That doesn't mean starting early with CPP. It just means let Service Canada know when you want to start it. Don't rely on them to start it for you automatically because it may be a headache and may cost you a lot of money in errors. Now, if you want to go a bit deeper on this topic and learn how you should withdraw from your accounts to boost your income and minimize your taxes, check out this video where I discuss a pretty common withdrawal mistake most Canadians make.